Welcome back to another episode of the Vet Worthwhile podcast. I am James Yost, partner and wealth advisor at SignatureFD, and I'm joined as always by my co-host Travis York, owner of 3-1 Advisors. Travis, how are you?
I'm doing great today, James. How about yourself?
I'm doing well. All right, welcome back to another episode of the Vet Worthwhile podcast. James Yost here, joined as always by Travis. Travis, how you doing?
Doing well this morning, James. How about yourself?
I'm doing great. Super excited about our guest today. It is my colleague and friend, Tony. You're supposed to laugh at that part. Tony Welch. So Tony he's our chief investment officer. Prior to joining SignatureFD, he spent 11 years at one of the most respected independent research firms in the entire United States, Ned Davis. Tony joined SignatureFD in 2018 and has ascended to the chief investment officer role. He's a partner of SignatureFD. Tony, welcome. Thanks for joining us on the Vet Worthwhile podcast.
Yeah, thanks for having me. I couldn't be more happy to be here. I'm looking forward to getting into the discussion.
It's going to be an exciting discussion. Well, maybe we'll just kind of get right after it. Obviously, if you turn on the news, you can't help but notice that the conversation's all about inflation right now, Tony. So, I mean, would you be willing to share, and again, wrap it into veterinary medicine however you can, just macro level, what are your thoughts on inflation? Where is it going? Should we all be scared that this is going to be a crash landing, or do you see this kind of starting to ease out of this? And what's the timeline on that?
Well, that's a multifaceted question, but we'll start with kind of.
I like to start easy for you, Tony.
Yeah. We'll start with the kind of overview of inflation. To try to get an understanding of where we're going on inflation, you really have to kind of understand where we've been. So the pandemic came, obviously created a huge mismatch in supply chains. You get a lot of stimulus in the system. You can't spend it on services. This is an economy made up of services. All of a sudden, where could you spend it? You could spend it on goods, durable goods. Supply chains globally weren't set up for that. We saw what happened. The result is just Econ 101. Too much demand chasing too little supply, and prices go up. And we saw it first in goods pricing, durable goods. And then the reopening started to happen, and we started to see it creep through in services. House prices went up. So your shelter costs, fuel prices went up. Obviously, that was exacerbated by Russia, Ukraine this year. And, a lot of economists, including the Fed, got in a lot of trouble for using the so-called T word, transitory. But the reality is a lot of the inflation is going to end up transitory. When we see where inflation is starting to go, a lot of the supply chain issues are behind us. Obviously, for vets, you probably...
But can I jump in? Just transitory, that is probably something that for a lot of our veterinarians is not a common word. So when you're talking about that, Tony, can you kind of help the audience understand what that might mean?
Yeah, that's great. Yeah, transitory is, we're just saying temporary, that it's not going to persist, that it's not going to stick around forever, that it's potentially a one-time shot to inflation, and it's going to peter out and settle down back into a more normal range. I think the supply chains are things maybe, if you have some insights into what vets have experienced from a supply chain perspective, but generally across the economy, we're seeing some pretty good easing of those conditions. So I'd be curious, anything that you're seeing from the vet space in that?
Yeah, I mean, we're hearing a lot of different things. I mean, one of the things we wanted to get from you, Tony, is the macro insights are extremely helpful, obviously, but what are you seeing on a small business level? Because for most of our listeners, they're small business owners effectively. And so price increases that they're having to deal with. I mean, labor is a big one, obviously, but also on the supplies that they get. And there still are delays out there on specific things. So what are you seeing at the small business level when you're looking at all the data?
So labor remains kind of the big elephant in the room from the small business perspective. So you look across at surveys of small business owners and you say, how confident are you in your forward outlook? How confident are you in your present situation? And what's your biggest headwind? And you look at those surveys, and unfortunately, confidence isn't very high among small business owners right now. It's actually some of the lowest we've seen, coincidentally, since the 1970s, the last time that we had wage inflationary pressures, the last time that you had just generally inflation in the system. But we are seeing less respondents say that the supply chain is their biggest issue. It really has shifted to labor. That is seemingly the biggest issue. Cost of labor, the availability of labor. That's where we've got some mismatches out there. And I would say, as we think about next year, Fed policy is going to be dictated by what happens to inflation on a macro level. They're worried about labor and wage prices and the stickiness of wage prices. And that's what's funneling through to small business owners right now. Now we can get into it if you want, in terms of looks like there's going to be some improvement in 2023 from the wage pressures that we've seen this year.
That's great, Tony, because I would be willing to bet if we did a survey that the number one concern for our hospital owners is the availability of labor and the cost of that labor. So that sounds like there's some help on the way, which is something that they're very much so looking forward to doing.
Potentially, if you think about what's happened with wages, what's true for the individual is true for the broader economy as well. So there's kind of this example of an apple farmer. So think about an apple farmer that has capacity to make 10,000 apples. If there's demand out there for 6,000 apples and that demand goes to 8,000 apples, that's not really a problem, right? That doesn't really show up in inflation. But what if there all of a sudden is demand for 12,000 apples? The apple farmer can't make 12,000 apples. So what happens is you have to destroy demand by bringing prices up. And we're seeing the same dynamic in labor right now, where pre-pandemic, there was a labor demand and a labor supply that matched each other well enough that wages were stable. Now, what you have this plethora of job openings out there without enough people to fill them. So when you look at the hard data at its worst, there was 2 job openings to every single 1 job seeker. An environment like that, when you're that kind of out of whack from a supply demand perspective, puts upward price pressure on wages. However, that has receded. So when we think about what can happen in 2023, it's not receded a ton yet. It's gone from 2 job openings to every 1 job seeker to 1.7 to every job seeker. But the point is help is on the way. It's getting better. The trend should start to loosen as we look at next year.
So, that just is so compelling to me, right? Because obviously there's the macro stuff, and I'm sure you probably don't get up every day and study the veterinary world in what you're doing. But right now they're projecting a shortage of 15,000 veterinarians. I don't know if we caught up on that ahead of time. By 2028, I heard, just topically that, during the pandemic, you were looking at, 6 jobs for every veterinarian that was actively seeking, just from a macro perspective. I hear you talking about stabilization. I don't want to create undue angst for people, but there's some, kind of very micro level factors that are impacting veterinary medicine. And how do you see the macro stuff that may be a stabilization, combining with industries that are still dealing with some, industry level shortage, where it's a technical skill. It's not like you or I could say, hey, there's a shortage, I'm going to go step in and take this. If we decided tomorrow, both of us wanted to go tap into this job market, we're probably 6 years away from being ready to do that.
Possibly. And I think that what you could see is a bifurcation among industries. And actually, we are already seeing it, right? There's certain industries that are already losing jobs. Forget about clearing job openings. They are flat losing jobs. And they tend to be the most interest rate sensitive industries right now. The manufacturing sector is starting to lose some jobs. The tech sector has been losing some jobs. If you consider that, I know this isn't about stock prices necessarily. It could be a little bit about valuations as we get into the conversation, but tech stock prices hinge on what interest rates are doing. And interest rates are higher and their stock prices have gone down, and there's been layoffs in the tech sector as well. But there could be other industries, specifically in certain medical practices that do experience a little bit longer term of a labor issue.
That makes sense. Well, you kind of brought it up as valuations. Obviously, private equity and outside investors, just kind of capital has flooded into the veterinary space. Mm-hmm. I mean, I grew up in this world, and in 1995, there was really no outside capital, right? The business was owned by an owner operator, probably lent to by a small community bank, or funded itself. And private equity started to kind of drift into this space, and we saw just an incredibly rapid rise in valuations, going from in 2011 you might have had a hospital valued at 7 to 8 times EBITDA, to at the peak of the pandemic it was not unheard of to get a 22 times forward looking EBITDA number. Those have now plummeted back to where we're looking at 10 times EBITDA. Can you talk a little bit about just kind of that stabilizing, and have you seen this happen in other industries you've studied, and then where does that go long term as we maybe reach more of a stabilized interest rate, factors that impact that?
Yeah, I think multiple expansion, in other words, PEs going higher, is a thing of the past. So we've shifted into an environment where interest rates are likely to be structurally higher than they were before COVID. So the 0% interest rate environment is likely behind us, which, by the way, that would be a good thing, because that means that we're healthier from an economic perspective. You don't need an emergency policy setting. But valuations have a very strong correlation with interest rates. So when interest rates are very, very low, valuations tend to go higher. And when interest rates move higher, valuations tend to contract. And that is true for every industry out there. So that is what we're seeing, but not all is bad, right? Because
so hang on. So this contraction in values is not like I so many people we talk to live in the vet world, right? And they're like, oh, this is only a vet problem. This is not. This is something that's everywhere. So like veterinarians, as special as they are, this is not a unique topic being discussed and only in veterinary medicine.
Not at all, Travis. I will say I do believe vets are very special, but and vet practices are special. But being an owner of a couple dogs myself, I truly appreciate the value of the vet service. But no, it really is across industries. Valuations do tend to hinge on big macro factors like interest rates out there. So that's certainly, it's just finance 101, right? I mean, you've got some sort of future cash flows. You've got to discount those cash flows at something. If the discount rate goes up, valuation comes down for those cash flows. Now, I would pivot and say that not all is bad. If valuation's stable at a more normal, like you said, 22 times that's pretty insane.
Unless you were a seller, it's kind of a crazy number.
Yeah, it's pretty strong multiples. But I would argue that if interest rates are higher for longer because you've had stabilization in the economic backdrop, then it's possible that earnings across a multitude of different industries are good. So potentially you're getting 10 times on a better EBITDA, right? So there is a possibility if interest rates fall, then what you're probably looking at, if interest rates are back at zero, you're probably looking at a pretty bad economy and a pretty bad economic outlook. So maybe your valuation is a little bit higher, but on what?
Yeah.
And that, it's kind of
That's a great segue, Tony. So I was meeting with a vet last night, and his biggest fear right now is what he sees on the news when he turns on every night, the financial news networks, the CNBCs, of the doom and gloom prognostications about a deep recession. That's something that's on his mind. So as you think about 2023, 2024, we've talked a lot about interest rates falling, rising, stabilizing. What are you seeing on the overall economic activity front? And if you could speak to it, I mean, some industries are more recession proof than others, or recession resistant, I would say. I think practicing veterinary medicine falls into a recession resistant category. But what are your thoughts on all this?
Absolutely. So, and I do think if we were to experience a 2023 recession, it would be extremely granular, that not may and probably mild. Nothing that you would look at be an experience like 2008 or something like that. If you look across the economy, there's several moats right now from an economic growth perspective that we didn't have in some of the worst recessions that we've experienced historically. I mean, you think about consumer balance sheets are really strong, really quite strong. All that stimulus that came into the system, most of it was in fact saved. So something like $3 trillion of stimulus came in. 2.2 trillion was saved that wouldn't have been in savings pre-stimulus package. Of course, it's starting to get worked down right now. Inflation's been a problem and the savings are starting, but you still have about $1.5 trillion sitting in savings there to insulate folks against a recession. We also just don't have the excesses in the system that lead to, really terrible recessionary activity. What we think in terms of the granularity, guys, and to your point of some industries are more resistant to it than others. Number one, we don't think it's written in stone that you're getting a recession next year. But if you do, it will probably be broadly focused on the most interest rate sensitive corners of the economy. Namely, I've already mentioned tech. You can see further job losses in tech, but housing. So housing is squarely where you need to focus on for kind of where the next recession could be, especially when we consider that something like 15 to 20% of all jobs in the US have something to do with the housing market, or somehow levered to the housing market. So if rates stay higher for longer next year and you don't get a resumption of activity in the housing market, that's probably what the next recession looks like.
So no, you talk about housing, and I'm going to just take a big leap here, just tying it back to kind of some of our veterinarians.
Yeah.
A lot of the veterinary hospitals also have real estate that are owned with the business, right? We're sitting in a high-rise building in downtown Atlanta right now, and unfortunately, putting a veterinary hospital on the 15th floor of an office building doesn't work, right? So they end up owning their own real estate. Is that something that they should be, like, at a macro level concerned about a real estate holding? A lot of veterinarians feel very sound in those investments. What are your thoughts on just kind of the commercial, like, standalone, 5,000 square foot building kind of heading into this potential recessionary housing market driven recessionary period?
It's such a good question. It's so important for your listeners. And again, I'm going to offer something that's somewhat unsatisfying, because in real estate, right, they say location is everything, but the type of structure, I think, matters a lot right now. This type of building we're sitting in right now, who knows what this thing is worth when you're considering, work from home policies of COVID and the long-term drivers of that. But the type of real estate that a veterinary practice owns may be much better insulated, because it needs to have real business in there and that type of thing. So there is going to be a bifurcation. I'm going to pivot and just give you a little bit of an anecdote from the residential markets, and it kind of showcases some of it depends on how, is timing, right? Like, timing is everything when it comes to investments. When did they purchase the property? My guess is that they've been in that property for a long time. They're sitting on substantial gains that a 15% contraction in prices is not going to completely wipe out.
Yeah.
Right. But if they just purchased the property summer this year, it is possible that they could end up underwater on that, and where the property is. And this is where I'm getting to from the residential. I don't have good data on the commercial, but you can get kind of an idea of it from the residential. Take a look at housing prices in all the different metros, the major metros of the nation right now. And would you believe that Atlanta housing prices are roughly 0.2% off of their peak level right now? So almost no contraction at all in the Atlanta metro in prices. San Francisco prices 15% off their peak already. So location matters, the use case for the building matters, and when they purchased it, I think matters for their experience.
No, that makes sense. So you kind of started to lean into, a little bit of, some of your thoughts and obviously guiding, where people go. What James and I do with a lot of people is help them. I kind of help on the front end getting prepared for that, succession and exit. And then James is guiding them through, that whole process, and probably working with you on some of the investments and where to put capital and how to think about just broader protections for themselves. Unfortunately, we've had a couple of conversations, James, where people go, well, the world's a little topsy-turvy. I think it's just better to take all this money and put it under my mattress. Mm-hmm. What's your kind of guiding principles as you're helping people, again, manage anywhere from, a very reasonable, retirement that is, lower millions to, somebody who may have 5 times what they thought they were going to have at retirement. How do you kind of think about that?
We try to identify tools for all the jobs, and we try to put things into kind of a bucketed approach, a framework that we call grow, protect, give, and live. And within that framework, you really need to identify how much of your capital needs to grow to support future living goals. How much capital do I need to live today? What do I need to protect myself today? And when you really start to splice those things out, you can start to set timelines on these things. So what I would say to folks that are, the world's a little topsy-turvy, I don't know if I feel confident in the market, so I don't know if I feel confident in whatever. Well, what you need to live on today and what should be protected for you today probably shouldn't be in the markets, right? T-bills are yielding over 4% right now. That's not such a bad return for money that you need to live on for the next year or two. But most people, it's not that simple. Even when you sell a practice, you got to live at some point in the future as well. And you need to keep up with those future spending needs that you have. And to do that, you need to grow your capital at a level at least as good at future inflation. We all want to do better in the future. So you want to do better than future inflation. And for that, you do need to move down the risk curve with some of your capital.
Yeah, and it's this huge thing we talk about. I mean, obviously, this is what I do on a daily basis. The biggest thing, it seems, for most people, and they're comfortable with equity risk, right? Because they understand the value of their practice is obviously an equity investment. I mean, they understand the benefit of ownership. The challenge seems to be in going from an illiquid asset that they have more control over to an illiquid asset that they no longer control. But just like what Tony was saying, I couldn't have said it better. I mean, the structure, the education, those conversations is what empower clients to effectively understand and take that risks with that grow capital once we've accounted for the live capital in a meaningful and thoughtful way. So that's like the biggest piece, I would say.
No, I think all of that obviously is just great insight for people who, quite frankly, have been accustomed to living out of a small business for most of their careers and having all of their assets tied up in probably 1 or 2 different assets, right? A veterinary hospital and a piece of real estate. And this is a brand new experience for a lot of our clients.
Yeah. Tony, before we wrap and we do a little summary, any last advice, any last words, any last parting wisdom you'd like to give our listeners?
Yes. So the world is topsy-turvy, but unfortunately, it always is. So we're not going to wake up tomorrow and the world's instantly not going to be topsy-turvy. We're not going to wake up a year from now and the world's not going to be topsy-turvy. When you're kind of looking at the world through an investment lens, it really needs to be a proper long-term lens with the understanding that there's never a perfect time to implement a strategy. The news flow will always be negative. That's just the nature of the beast. You've got to keep eyes glued to the screen, right? The parting words of wisdom are around design. If you, I know that it can be scary, Travis, you were alluding to, it can be scary to go from something and you've had control over your whole life to something that's in the hands of board members in another country or something like that, and it's priced daily and all that. But you need to have confidence in the design.
That's awesome. So it's funny, the side story that I don't think I've ever told you this, Tony, but I've told it to a lot of clients. So a former coworker of mine worked for CNBC. I've probably told you this before, Travis. He worked for CNBC and as a junior producer early on in his career, and they would literally go in and pitch the senior producers on who would have the scariest headline. Like that's literally how the news was created at CNBC at that point in time. So I always think that's interesting just because, that's what people share. That's what scares people. We can get into that. It's a whole other topic.
The news is crazy. I was talking with my family about it. I don't want to literally, if you turn on the nightly news, there's like 5 segments, right? Like if you watch the news consistently for like 10 nights, like they just recycle the same stories, like whatever is, and it's like, it can take you down a dark path if you start spending too much time listening to that stuff.
Yeah. We'll maybe do a separate podcast episode on the news. Y'all were talking about baseball earlier. We'll get to that. So just to summarize the things we talked about. So on the inflation front, you're seeing labor costs remain elevated. Most of the supply chain issues are hopefully behind us at this point in time. Good news is it seems as though there is starting to see some betterments in labor conditions, which is a great place to start. On the private equity markets, we're thinking potentially going to see multiples stabilize, but if interest rates remain elevated where they are today, that likely points to a healthy economy, which means could be better EBITDA for the practices, which, even coupled with normal multiples could lead to a good success for them on an exit. Lastly, on the recession side, this is a different recession than what we've ever seen if we go into run, which is not guaranteed at this point. Our thought is it's granular, likely mild, and that the interest rate sensitive industries would likely be challenged the hardest. Is that a fair summary, Tony?
I spoke for 40 minutes.
Yeah.
Thanks, Tony, for that 30 seconds. Great job.
There you go. So Tony, where can people find you? Like if they wanted to tune in, is there anything that you do that they could access if they really enjoyed your content here today?
Absolutely. We try to make sense of all this craziness in several different ways. One, we produce a weekly newsletter that we would love add folks to the list. We also do a monthly webinar where we actually walk through some of these data points so you can see what's supporting our perspective on things, in a quarterly newsletter that we go into depth on the macro outlook and kind of valuations in the market, what we're seeing in the market. So several different ways to get our thoughts and perspectives on the world.
Awesome. Love that.
Thanks for joining us. This was great. I'm super excited for our listeners to be able to gain some knowledge from you.
Yep. It's been the Vet Worthwhile podcast with James Yost, Travis York. Our guest was SignatureFD Chief Investment Officer, Tony Welch. Tony, thanks so much. Great talking to you, man. See ya. Thanks again for tuning in to the Vet Worthwhile podcast. You can find us online at signaturefd.com/signatureveterinary. And then our ask would be, if you found this episode valuable, just think of one friend or colleague that you think would enjoy the content and just please share. So thanks again. We'll see you next time.
Travis York is the owner of 3-in-1 Vet Advisors and a partner of SignatureFD. 3-in-1 Vet Advisors is a veterinary consulting and strategic planning firm of which SignatureFD has no involvement or ownership. James Yost is a partner and wealth advisor at SignatureFD. SignatureFD is an investment advisor registered with the U.S. Securities and Exchange Commission. 3-in-1 Vet Advisors and SignatureFD are not affiliated. Mr. York provides all non-investment advisory services through 3-in-1 Vet Advisors. The opinions of the guests and the contents of this podcast are intended to be educational only and should not be relied upon as investment, tax, business, or planning advice. You should consult with a professional advisor prior to taking any course of action that may impact you or your business.